What if you could, well, basically force the government to add 25% to your charitable donations, and it wouldn't cost you a single extra penny?
Right. I mean, seriously, think about that for a second.
Yeah, you give a charity your money, and the government is legally obligated to just reach into its own coffers and top it up.
It honestly, it almost sounds like a financial scam when you phrase it that way.
It really does.
Yet, so many people leave that money just sitting on the table simply because the mechanics of how the UK tax system processes charitable giving feel a bit, well, intimidating.
Which is exactly why today we are going to completely demystify the UK's charity tax reliefs. We've got a genuinely fascinating stack of sources for this deep dive.
Oh yeah, we are going right to the source material today.
Right, we are looking at official HMRC guidelines. We've got some high-level financial strategies from Stewardship, insights on payroll giving from Good Pay, and the actual practical, behind-the-scenes charity policies from Age UK and Fight for Sight.
The reality of charitable giving in the UK is that, well, the tax code is doing a tremendous amount of heavy lifting right behind the scenes.
Yeah.
And if you know how to pull the right levers, your impact just multiplies.
Exactly. And our mission today is to show you how to make your money work so much harder for the causes you actually care about.
Mm-hmm.
So whether you are just dropping a fiver into a collection bucket on the high street, or you are earning over £100,000 and trying to navigate the notorious 60% tax trap, this deep dive is going to change how you look at giving.
It completely shifts the perspective, I think. It moves it from just giving money away to real strategic financial allocation.
Okay, let's unpack this. Starting with the absolute basics, which is gift aid. I mean, you see the little tick box on literally every charity website and every donation form.
Every single one, yeah.
The core mechanism is straightforward,
Mm-hmm.
right? Gift aid allows charities to claim back the basic rate of income tax that you, the donor, have already paid on that money.
Right, because you earned that money, you already paid the 20% basic tax rate on it through PAYE or self-assessment.
Exactly.
So the government essentially says, well, if you're giving this cash to a public good, we won't tax you on it.
Makes sense.
So for every £1 you donate, the charity gets 25 pence back from HMRC. A £100 donation just magically becomes 125 pounds.
It really is a brilliant system. But reading through the Fight for Sight and Age UK policy documents, there is this fascinating physical limitation to this rule.
Yes, there is.
HMRC states that gift aid only applies to money, like cash.
Yeah.
It absolutely does not apply to physical goods.
Right. You cannot gift aid a bag of old sweaters or, a box of donated books.
Which is wild to me because how on earth do charity shops claim gift aid on the clothes you drop off then?
Well, that's the trick.
Because every time I bring a donation bag to a high street charity shop, they literally ask me to sign a gift aid declaration form on their little tablet.
Yeah.
If my sweaters aren't cash, what am I actually signing?
You are signing an agency agreement.
An agency agreement.
Yeah, because HMRC says you can only gift aid money. The charity shop cannot simply take your clothes, sell them, and then claim gift aid on their profit. That's illegal.
Oh, wow. Okay.
Instead, they use this brilliant piece of, well, administrative gymnastics called Retail Gift Aid. The charity legally acts as your sales agent.
Wait, so it's like turning the local Age UK into my personal consignment broker just to satisfy the tax man?
That is exactly what is happening, yes.
That is hilarious.
You legally still own those clothes while they hang on the rail in the shop.
Really?
Yes. And when someone buys that sweater, the charity has technically sold it on your behalf.
Okay.
They then take a tiny commission, usually around 2% or so, for their trouble. And it is worth noting that this commission is actually subject to VAT.
Oh, of course it is.
Yeah, because providing a sales service is a taxable business activity.
The tax man always gets his cut somewhere.
Always. But after that commission is deducted, the cash proceeds technically belong to you. And in that same agency agreement you signed when you dropped the bag off, you pre-declared that you want to officially donate those cash proceeds back to the charity.
Okay, so the order of operations here is I hand over the clothes, the charity sells them for me, hands me imaginary cash, and then I instantly hand that imaginary cash back as a formal donation.
Exactly. And because it is now a cash donation, the charity can legally claim the 25% gift aid top-up on it.
That is incredibly clever.
It is.
Yeah.
And to make this legal without burying you in paperwork every time they sell a pair of your old socks, charities use a specific HMRC method for low-value goods.
Right. Method A, I think it was called in the sources.
Yes. If your items sell for under 100 pounds in total, they don't even need to write to you to confirm you still want to donate the money. They just process the gift aid.
But doing this must require intense logistical tracking, right?
Oh, absolutely. Every single item you donate gets a specific barcode tag tied to your unique donor ID so they can prove to HMRC that the proceeds came from a registered taxpayer.
They have to trace that specific sweater back to my specific tax record,
Yes, they do.
which actually exposes what I thought was a massive logical flaw in this whole system when I was reading through this.
How so?
Well, if charities need a signed declaration, like a specific donor ID and a verifiable tax card to claim gift aid, what happens to the 5-pound note I just drop in a collection bucket at the train station?
Ah, right.
Or when I tap my card for 10 quid at a charity marathon run? Because
Yeah.
getting a signed tax declaration for every single tap or loose coin is just physically impossible.
It is impossible. And for a long time, charities just lost out on that tax relief entirely.
That's a huge loss.
Yeah. But the government finally recognized that friction and introduced the gift aid small donation scheme, which is usually referred to as GASTES.
Okay, so how does GASTES fix the bucket problem?
So JZGAs allows charities to claim that exact same 25% top-up on cash or contactless donations of 30 pounds or less without any declaration from the donor whatsoever.
Wait, none?
No name, no address, no proof of taxpayer status, nothing.
Wow.
If a volunteer collects 20 quid in a bucket, the charity just records the date the total cash collected when it was banked, and they claim the extra 5 pounds directly from HMRC.
That is amazing. And charities can claim top-ups on up to 8,000 pounds of small donations a year through this scheme, right? Which translates to a maximum of 2,000 pounds in free government money annually.
That's the standard limit, yes.
And reading through the HMRC guidelines, there is a fascinating community buildings loophole that actually increases that limit.
The village hall rule.
Yeah. If a charity operates out of a village hall or a religious building, they can claim more than the standard limit, provided they host at least 6 charity events there in a year with 10 or more people attending.
Exactly. It is designed to heavily subsidize grassroots community organizing and local hubs.
I have to push back on this, though,
Okay.
because my brain immediately goes to the potential for fraud here.
Yeah.
If a charity doesn't need to prove who gave them the cash, couldn't a fake charity just claim they had a very generous village hall meeting, pretend they received 8,000 pounds in anonymous cash, and just pocket the $2,000 from the government?
What's fascinating here is that HMRC designed a highly specific failsafe for exactly that scenario.
Oh, really?
Yeah, it's called the 10 times rule. A charity's Gares Maras claim, so the anonymous bucket money, can never be more than 10 times their standard declared gift aid claim.
Ah, okay. So you have to prove you have a foundation of real, documented taxpayers making donations first.
Exactly. If you want to claim a top-up on 1,000 pounds of anonymous bucket donations, you must have successfully claimed standard gift aid on at least 100 pounds of properly documented paper trail donations in that exact same tax year.
I see.
You have to prove you are a legitimate functioning charity with real supporters to unlock those anonymous cash top-ups.
So we have established how the government strictly monitors the anonymous cash coming in to prevent fraud. But the sources show they are equally strict about what the charity gives back to you.
Oh, incredibly strict.
Because charity isn't always just dropping money into a void, right? Sometimes you get a pork, a dinner, a tote bag, maybe a prize at a gala.
And this brings us to what HMRC calls the benefit rules. The absolute golden rule of gift aid is that the donation must be a freely given gift.
Right.
The very moment you receive a perk, it fundamentally changes the transaction. If you are basically just buying something, it is no longer a pure donation.
So let's look at the mechanics of how they police this thank you trap. If a charity gives me a perk, how does HMRC actually calculate the value of that benefit?
The value of any benefit is strictly assessed at its retail value, not what it costs the charity.
Okay, that's an important distinction.
Huge. Say a local business donates a 50-pound bottle of wine to a charity for free.
Nice.
If the charity gives that bottle to you as a thank you for a donation, HMRC views that as you receiving a 50-pound benefit, even though the charity paid absolutely nothing for it.
Wow. And HMRC uses a sliding scale to determine how big a thank you gift can be before it completely invalidates the gift aid, don't they?
They do.
The core logic seems simple enough. The larger your donation, the smaller the percentage they allow for a perk. and they cap it hard at £2,500, no matter how massive your donation is.
Yeah, let's apply this to a real-world scenario, like a charity auction, because this is where well-meaning donors just constantly trip up.
Okay, let's say I'm at a charity gala. I've had a glass of wine. I'm feeling very generous, and I bid £500 for a signed football shirt.
Okay.
Now, the shirt itself normally cost £100 retail. Is the
Yeah.
whole 500 quid gift aided because it's a charity event?
No, it is not.
Right.
HMRC requires you to split the payment. You subtract the retail value of the item, so the £100 for the shirt, from your winning bid.
Okay.
You effectively bought the shirt for £100. The remaining £400 is considered your excess donation, and only that $400 qualifies for gift aid.
So the charity still gets my full £500.
Correct.
But they only ask the government for the tax back on the $400 pure donation part,
Exactly.
which means the auctioneer actually has to make the retail value of the item clear to the bidders before the item is sold, so the tax math works out later.
They legally have to, yes. And this same logic applies to schools, which is just a massive trap for parents.
Oh, I bet.
You are constantly asked for voluntary contributions for school trips, but educational trips rarely qualify for gift aid.
Because the child is receiving a direct benefit.
Exactly.
Like if my kid's school asks for a £10 voluntary contribution for a museum trip, and the actual cost of the transport and the ticket is £8, the benefit my child receives is 80% of my donation.
Right, which completely shatters HMRC's limit for perks.
So it is 0% eligible for gift aid. You are just paying for a service for your kid.
It is a hard truth for PTA treasurers everywhere, I'm afraid.
It really is.
Yeah.
So we have optimized the collection bucket, the charity shop, and the gala auction. But the Good Pay source makes a really compelling argument that for higher rate taxpayers, standard gift aid is structurally flawed.
Oh, it really is.
And this brings us to a crucial comparison for this deep dive: gift aid versus payroll giving.
Yes. It all comes down to the timing of the tax calculation.
Right.
Standard gift aid happens post-tax. Payroll giving happens pre-tax.
I like to think of payroll giving like a VIP lane at a toll booth.
Yeah.
Your donation exits your paycheck before the taxman's toll booth even registers it.
That's a great way to put it.
Whereas standard gift aid is driving through the toll, paying the tax, and then the charity has to chase the toll collector down the highway to ask for a refund.
That is exactly what it is. And for anyone paying the 40% higher rate or the 45% additional rate, the efficiency of that VIP lane is staggering.
Let's look at the Good Pay example for a 45% taxpayer.
Okay, yeah.
Suppose you want your charitable giving to cost you exactly £10 out of pocket. That is your strict monthly budget.
Right. If you do that through a standard direct debit using gift aid, you donate your £10.
Yep.
The charity claims the 20% basic rate from HMRC, which adds £2.50. The charity gets a total of £12.50.
Now, let's move that exact same donation to your company's payroll giving scheme. Because the money comes out of your gross pay before the 45% income tax is even applied, you can authorize a gross donation of £18.18.
Yes.
And because I am not paying that 45% tax on the £18.18, my actual take-home net pay only drops by £10.
Exactly.
So by simply switching from a post-tax direct debit to pre-tax payroll giving, I am effectively letting the taxman pay for nearly half my donation before the money even leaves my paycheck.
It's incredible math.
I turn a £12.50 impact for the charity into an £18.18 impact without losing a single extra penny from my own bank account.
And the efficiency for the charity is unparalleled. They receive the full £18.18 instantly.
Right, no waiting.
They do not have to spend admin time filing paperwork with HMRC to claw back the basic rate gift aid months later. It is just better for everyone.
Payroll giving clearly supercharges the charity's take.
Without a doubt.
But the stewardship source shows how strategic giving can actually rescue the donor's personal wealth from some notorious UK tax traps as well.
Oh, absolutely.
And the biggest one is the £100,000 trap.
Ah, yes. This is a particularly painful spot in the UK tax code.
It's brutal. The 100K trap is brutal because everyone gets a personal allowance, which is currently £12,570, that you can earn completely tax-free.
Right.
But the moment your income crosses £100,000, For every £2 you earn over that threshold, you lose £1 of your tax-free allowance.
So you are not only paying the 40% higher rate tax on the new money you earned, you are also being retroactively taxed on the foundation of your income that used to be tax-free.
It's a double whammy.
It is. You are effectively paying a 60% marginal tax rate on your income between 100,000 and 125,000, 140 pounds.
And at 125 grand, your tax-free allowance is entirely gone.
Wiped out.
And this is where charitable giving flips from an expense into a literal financial superpower.
Because gift aid donations actively reduce what HMRC calls your adjusted net income.
Right. Let's use the stewardship example.
Okay.
Say you earn exactly 125,140 pounds. Your personal allowance has been wiped out to zero.
Sad but true.
But you make a strategic charitable gift of 20,112 pounds.
When the basic rate gift aid is added to that, the gross value of that gift is 25,140 pounds.
Right.
HMRC subtracts that gross gift from your salary. So suddenly, in the eyes of the taxman, your adjusted income has dropped back down to exactly 100,000 pounds.
Meaning you fully restore your entire 12,570 pound tax-free personal allowance.
Yes, you do.
You trigger a massive tax rebate.
Huge.
When you factor in the higher rate tax relief, you personally claim back, plus the tax saved by restoring your allowance, that 25,000 pound gift to the charity effectively only cost you a bit over 10 grand out of pocket.
The government is essentially subsidizing more than half of your donation.
And it gets better, because dropping your adjusted net income back to 100K also restores your eligibility for the childcare bonus.
Oh, this is a massive point.
If one parent earns a single pound over 100K, the family instantly loses access to tax-free childcare and the 30 hours of free childcare scheme.
It is a terrifying cliff edge for working parents.
Truly. But by giving that excess income to charity, you pull yourself back under the cliff. You give to a cause you love, and you get thousands of pounds of childcare funding back from the government.
You could literally find yourself financially better off overall by giving money away. It's a paradox, but it works.
But there is another tax trap for ultra-high earners, where the type of donation you make becomes critically important.
Ah, yes.
The pension taper.
This one catches a lot of people out. Normally, you can put up to 60,000 pounds a year into your pension tax-free.
Right.
But if your adjusted income goes over 260,000 pounds, that allowance tapers down, eventually hitting just 10,000 pounds.
So the logical assumption here is, well, just use standard gift aid to lower your adjusted income below 260K, just like we did for the 100K trap, right?
HMRC anticipated that, unfortunately.
Of course they did.
Standard cash gift aid does not lower your adjusted income for the purposes of pension tapering. They deliberately carved that out of the tax code.
Wow, so throwing cash at a charity won't save your pension allowance at all.
No, it won't. To fix the pension trap, donors must use payroll giving, or they have to donate assets directly, like shares or property.
Oh, I see.
Because those methods avoid income tax entirely up front, they successfully lower your adjusted net income for the pension taper.
That is a very specific workaround.
It is a highly specific structural nuance, yeah, but understanding the difference between cash and payroll could literally save a high earner tens of thousands in tax.
The mechanics completely dictate the outcome. Let's recap this journey, because we have covered a lot of ground today.
We really have.
We started with the core logic of gift aid, claiming back the 20% basic tax rate to turn £1 into £1.25.
Yep.
We explored the Retail Quirk, where charity shops become your personal sales agent to make physical goods eligible for tax relief.
The brilliant agency agreement.
Exactly. We saw how the government polices anonymous cash through the gas D's 10 times rule, while simultaneously policing outgoing perks by strictly deducting their retail value.
And then we moved from optimizing the donation type to optimizing the timing of the tax. We saw pre-tax payroll giving vastly outperform post-tax gift aid for higher earners.
And finally, we explored how strategic giving can rescue your personal allowance, restore your childcare benefits, and safely navigate the pension taper.
It really completely reframes the concept of philanthropy in the UK.
It does.
Which I think leaves us with a final thought to ponder.
Let's hear it.
When you truly understand these mechanics, charitable giving stops feeling like a purely altruistic sacrifice of your wealth. It becomes a highly efficient financial tool to literally redirect your tax bill away from the central government and point it directly toward the local causes you care about most.
So consider this. What if charities stopped just asking for emotional donations and instead started pitching themselves to high earners as bespoke tax planning services?
That would change everything.
If taxpayers realized they could optimize their own wealth by funding charities, could private citizens effectively crowdsource social safety nets better and faster than the state?
It is a really powerful question about where our money goes and who actually gets to decide how it's spent.
What if you could force the government to add 25% to your charitable donations without it costing you a single extra penny? Well, now you know exactly how to do it. Thanks for joining us on this deep dive.
Charities depend on maximizing every donation to survive, but the system of tax relief and HMRC regulations requires specific record-keeping to avoid substantial penalties. Today, we are going to build a 4-step system to capture valid records, handle corporate gifts correctly, survive an audit, and leverage your data for future growth. Before starting, you must have 3 things in place: registered UK charity or cask status, an official HMRC reference number, and a dedicated digital CRM to hold your records. Once set, this system makes your tax claims a predictable part of daily operations. Step 1 is individual gift aid. To access the 25% HMRC boost, your charity must hold a valid declaration form for every donor. A compliant declaration layout contains 4 non-negotiable fields: the donor's full name, home address, charity name, and a checkbox confirming they are a UK taxpayer. For verbal phone declarations, you must send written confirmation, giving them 30 days to cancel. Your operational goal is to establish a clear, easily retrievable file for every donor that explicitly authorizes you to claim that 25 pence per pound. If a single mandatory field is missing, or if the form is lost, the claim is void. This level of precision is required to maintain individual donation revenue. Step 2 requires recognizing a common reporting error: charities attempting to claim the 25% gift aid boost on gifts coming from limited companies. Corporate tax relief operates differently. When a business donates, they deduct the value of that donation from their total pre-tax profits, reducing their own corporation tax bill. Because the company claims the tax relief directly, the charity receives the gross donation amount up front. You do not submit a gift aid claim to HMRC for these funds. This split-screen flow sequence shows how money moves. On the left, individual gift aid brings extra currency from HMRC into the charity. On the right, the corporate donation stays at its face value inside the charity, while the business's tax liability graph shrinks. You can use this specific mechanic to your advantage. Pitching this direct tax deduction is an effective way to secure local business sponsorships. Respecting this divide prevents HMRC claim rejections and provides a clear financial incentive for your corporate partners. Step 3 prepares you for an HMRC audit. This checklist shows the 3 core pillars an auditor will look for: proof you meet legislative requirements, the valid declarations themselves, and evidence you have not exceeded donor benefit thresholds. You must connect a specific bank statement entry through your digital database directly to the original signed declaration form. Retaining a database record isn't enough. You must keep original forms for 6 years after the accounting period ends. There is an exception for small amounts. Under the Gift Aid Small Donation Scheme, you can log cash or contactless bucket donations of £30 or less without needing a signed declaration. This graphic outlines the cost of failing an audit. You would be required to repay all the claimed tax, plus interest, and face fines that can reach 100% of the tax repaid. Maintaining this audit trail is the primary requirement for keeping the tax relief your charity has already received. Step 4 involves using these same records for strategic analysis. By running reports through your CRM, you can map out historical donation trends over multiple years. This dashboard illustrates how that data is applied. By identifying drops in recurring revenue, like this dip during the summer months, you can plan a more sustainable budget. Analyzing this compliant data provides a clear picture for future mission planning. We have built the system: valid individual declarations, distinct corporate tax accounting, 6-year audit trails, and data-driven forecasting. Your next step is to test it. Pull one past donation record today and verify you can trace it back to its original declaration. Following these steps ensures your charity retains its tax relief while maximizing the impact of every donation you receive.